Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY22 earnings conference call of Apcotex Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand the conference over to Mr. Anuj Sonpal, CEO of Valorem Advisors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and a warm welcome to you all. My name is Anuj Sonpal from Valorem Advisors. We represent the investor relations for Apcotex Industries Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings conference call for the third quarter of financial year 2022. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings con call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Let me now introduce you to the management participating with us in today's earnings call. We have firstly Mr. Abhiraj Choksey, Managing Director, Mr. Sachin Karwa, Chief Financial Officer, and Mr. Anand Kumashi, Company Secretary. Without any further delay, I request Mr. Sachin Karwa to give his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj. Good afternoon, and welcome to today's earnings conference call for the third quarter and 9 months of financial year 2022. Firstly, let me take this opportunity to wish you all a happy new year, and I hope you all are keeping safe and well. Along with me in today's earnings call, I have our Managing Director, Abhiraj Choksey, and Mr. Anand Kumashi, our Company Secretary. I hope you had an opportunity to review the financial statements and earnings presentation which have been circulated and uploaded on the company website and stock exchanges. To brief you on the financial performance for the third quarter of financial year 2022, the revenue from operations grew by about 52% on year-on-year basis to rupees 251 crores. The operating EBITDA grew by about 40% on a year-on-year basis to rupees 34 crores, with EBITDA margins reported at 13.5%. EBITDA percent compared to Q3 of FY21 is lower, but that is on account of higher prices compared to last year. EBITDA margin per metric ton is an important metric we monitor, and that is better than last year. The net profit grew by about 43% year-on-year to rupees 24 crores, and PAT margin stood at 9.5%. For 9 months of FY22, the revenue from operations grew by 92% year-on-year around rupees 679 crores, while operating EBITDA grew by more than 100% to around 95 crores, with EBITDA margins being reported at 13.9%. Net profit grew by more than 100% to around 68 crores, while PAT margin stood at 9.99%. From the numbers, you can make out that we have reached historical highs in Q3 FY 2022 across all financial parameters. Quarterly volumes grew YOY for both Q3 and 9 months FY 22 due to the full benefit of all debottlenecking projects, all of which were completed between Q2 and Q3. In addition, we witnessed a healthy broad-based volume growth across most industries, customers, and geographies. We have registered the highest quarterly export sales of rupees 53 crore, contributing to 21% of overall revenues. On the project front, work on new extension project is on schedule and expected to be completed around Q2, Q3 of FY 2023. Finally, I am pleased to announce that we have declared an interim dividend of rupees 2 per equity share, and 11 February 2022 has been fixed as a record date by the board. With this, I would like to open the call for question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you. Yeah. So my first question is related to margins. So what is the reason for the margins to still be relatively stable? Can you speak a little on that?
Yeah. Hi, Ankit. How are you?
I'm good, sir.
I'm not sure if I've understood. Thank you. Thanks for your question. I'm not sure if I've understood your question. You're talking about EBITDA margins being stable, and what is the reason they have not dropped, or what is the question again?
Not dropped. Yeah, not dropped. Because across the board we are seeing commodity price increase, and we have still managed to continue to hold on to our margins. So what has led to that? That is what I wanted to know.
I know a couple of things obviously the commodity prices have gone up, even for us raw materials have gone up, but we've largely been able to pass it through. And as I've mentioned before, in our kind of business, for example, I'll tell you about this quarter, the revenue is up by 52% compared to Q3 of last year, and our volumes are up by about 20%. So the volume growth has been 20% compared to Q3 of last year, and the rest of it is margin growth. So obviously the volume growth has helped. And by and large, as far as on a rupee term, we've been able to pass through all the cost increases. And in fact, our EBITDA per ton, if you look at the rupees per ton, has actually gone up. EBITDA percentage may be stable or even a little lower than last year, but had there been no inflation, then our EBITDA percentage would have been much higher than, in percentage terms, been higher than Q3 of last year. So yeah, I mean, we've been fortunate and we've been able to pass it along. And obviously, a lot of things done internally at our end as well. The product and customer mix, we are running at almost 100% capacity utilization. So that has helped, overall. There doesn't seem to be any excess capacity right now, very strong demand. So all those things have really helped, and we feel different about these margins overall.
So, as in just a slightly longer term view on the same thing, as in if I just follow up on that, wherein since we are entering, the general belief is that we are entering into a inflationary phase right now, and it may carry on for say about 2 years, 3 years, or maybe 4 years. We don't know yet. And if you look at in the past, so if you can share with your own experience in the past when the crude is right now approaching 90, or it's already 90, I guess. So how does it affect us, and how easy or difficult it is for us to keep maintain that margin in that kind of an environment? Because in the last 3-4 years, the crude was pretty benign, but now in the last 1 year and the projection in the future also, like it may shoot up. How do we see ourselves in that kind of a scenario?
Look, first of all, the company, compared to the past and now, the company is also different. The different strategies that we have executed over the last 2-3 years after the acquisition, along with a lot of debottlenecking projects, product mix, customer mix, and so on, new products that we've introduced. So we feel a lot more comfortable. We are also at a much higher capacity utilization. The industry overall seems to be at a higher capacity utilization. So it does seem that these margins and this is more sustainable than before. However, look, the macro environment and how inflation overall affects demand and such, it's hard to predict really. All I can say is that we feel pretty confident that we will remain range bound in these kinds of percentage margins, anywhere between 12-13% to 17-18%, I would say, depending on where crude is. Now, if crude goes to $150, just for example, our margins may even fall further in terms of percentage. But in terms of actual rupees per ton margin, we'll ensure it's protected. We'll try and ensure that's protected at least by the different things that we've already done and we'll continue to do. And as you know, this year we are also looking at substantial capacity improvements. that should also overall help in, improving EBITDA margins. Of course, most of that will come into the second half of the year, not in the first half of the year, but next financial year. But so overall, we feel pretty confident about it.
Yeah, that really helped. And speaking about capacity, in the last call we mentioned about 220 to 230 crore of capex over the next 12 to 15 months. So
yes,
in terms of timeline, we are on course of that, or we are
absolutely on course. Yeah, as of today, all the projects, both the projects on both the sites are on course.
Yeah, one last question on Apco Build. So last call we mentioned about we entering Madhya Pradesh. Any other new states we have entered, or we are still concentrated on
Gujarat, Madhya Pradesh, within Maharashtra also increased our footprint, and Goa. So we're in 4 states. We're also doing small business in the south a little bit, but I would say largely these 3 states, Maharashtra expanding our footprint, and entered Gujarat and Madhya Pradesh over the last year or years.
So, is it possible for you to just share on Q basis what are the growth rates in Apco Build numbers in Q1, Q2, and Q3? Just percentage.
I don't have specifically Q1, Q2, Q3, but I have the YTD numbers. And I would say for this financial year as well, the growth will be it will be almost 150 to 200% for Apco Build this year, 150% at least.
And broadly, sequentially, you have grown in the last 3 quarters also.
Yeah, every quarter on quarter also. Of course, Q2 is always in this business always a little lax, but even then we have grown Q2 compared to Q1. Q2 because of the monsoon season, that's always this construction a little lax.
Okay. Thank you so much. I'll come back in with you if I have any other questions.
Thank you.
Thank you. The next question is from the line of Keval Ashar from DSP Mutual Fund. Please go ahead.
Hello, am I audible?
Yes. Go ahead, Keval.
Yeah, so first of all, congratulations, Abhiraj sir and your team for a good set of numbers, and also the way you've penned out your company over the last many years. Sir, I have a few questions. So first is, you are into emulsion polymer chemistry, and if we see your global competitors like Synthomer and Tensio, and the way they've scaled up, I believe that we have a huge size of opportunity lying ahead of us. So first of all, I wanted to understand from you that once our current capex commences and we start generating cash flows, what are the new products that you plan to scale up, and what is the size of opportunity that you see for Apcotex?
No, absolutely. Look, obviously Synthomer and Tensio and some of these other global companies, they operate in multiple countries and multiple continents, therefore they're larger.
Right.
We also see a lot of opportunity and good growth, and we've seen that this year itself, where for the 9-month period our volume is up 40%, of course, and revenue is up about 92% on account of inflation. But and of course, last year, April, May of 2021 was obviously, because of the lockdown and the plants were shut and so on, obviously was challenging. So on the basis of that, but yeah, absolutely, the opportunities are there. On the latex side, of course, I think it's more of a regional play. That means, we'd focus on Southeast Asia, Middle East, and India, because of, in latex it's about 50% water, so to transport it over very long distances may not make sense. So I would say yes, absolutely, the opportunities are there, and we continue, and that's what we have actually also exploited. And our export was close to zero 10 years ago. Now it's at 21% of the total revenue. This year we expect almost 150 to 200 crore, maybe almost 200 crores of top line to come from exports. So we have exploited that. We have taken advantage of that, and by proving again and again, it takes time in this kind of industry to prove to the customers that you're a consistent supplier, consistent high quality supplier, and we've done that now. And so one of the growth engines, as I've told you, has been nitrile latex for gloves, and that's what we're focusing the next 12 to 18 months on. In addition to that, we have, as I've mentioned before, even in our current industries, paper, carpet, construction, the demand has been very strong, I would say, in the last 9 to 12 months, and we continue to grow with that as well. In fact, if you see Q3, we are at almost 100% capacity utilization. In fact, we've had to let go of orders for the first time, and unfortunately not be able to take all the orders that we would have liked to take, especially both domestic and exports, in fact. So overall, we feel quite confident.
Okay, sir. Got it. And if you can throw some light on new products that you'd launch post the current CapEx, if you are working on a few products.
We are working on a few products. As I mentioned last time, as of now, our focus and what we have announced is the current capex of for latex products, which is nitrile latex in Valia, and a multi-purpose latex plant in Taloja, which will include all our current products as well. And in addition to that, after that, we also, we only have about 30% or less market share in the NBR business in India, and we are hardly exporting. We believe that in the long run, even though it's not a very high growth industry compared to, let's say, nitrile latex or some of the latex products, we believe there is a good opportunity for further import substitution in India, as well as export into Southeast Asia, Middle East, and Asia. And so we may double our capacity. At least we have everything ready on paper, and we may do that in 23, 24, depending on the macro environment, as well as depending on how the company is doing. So that would be our next phase of growth. And as far as new products are concerned, yes, we are, completely new ideas that are not in our current sphere. There are a few things we are working on, but as I mentioned in the last call as well, it would be a little premature for me to talk about it. We're also looking at inorganic growth opportunities, and again, very premature to talk about it till something happens. But obviously, all those opportunities are the few opportunities and few things in the works that we will, of course, mention to the investor and analyst community when we are ready.
Understood, sir. So my second question is on Apcobuild. So we understand that you've assigned a separate team for Apcobuild, and you are cautiously expanding the product. So can you throw some light on how do we stand out in this construction chemical market compared to our peers?
Sure.
What is the market size? And sure.
We don't really worry about market size, market share, and so on as far as that is concerned. We're backward integrated, and a lot of our products are being used in the construction chemical space. So we have a natural, obviously, cost advantage because we're backward integrated. In addition, we have, of course, added a few other products to complete a minimum range, but we are not necessarily competing with the with the large players in the construction chemical industry. We are trying to capture our downstream margins, which we've done well, and focus on a few other specialty products that we are outsourcing, that we believe we can add value in, which we understand, again, in the polymer and waterproofing space and repair space that we understand. We're not everything to everyone kind of construction chemical company.
Okay, got it. And so, given the lower base of revenues currently, what do you think can be our top line in the next 3 to 5 years in Apcobuild?
We don't give separate numbers for Apcobuild. It is, as I mentioned before, it's a small part of our company so far. We believe in the next 3 to 5 years it will become a larger chunk, and as and when we feel that it has some critical mass which is worth reporting as a separate segment, we will do that.
Okay, understood. And sir, just one last small suggestion, so that if you can give product-wise volumes and product-wise revenues in quarterly presentation, then that would be great for us also.
As I said before, we would love to be as transparent as possible, but I hope you would appreciate that there are certain things that are competitive, advantages to us, and certain proprietary information that we don't want getting out in the market. While obviously it's not the investor community, but a lot of other people also follow our investor con calls and our data, which we would like to avoid giving this.
No, that's understandable.
So, thank you very much.
Okay. Thank you so much, sir, and all the best for the coming years. Thanks.
Thank you.
Thank you. The next question is from the line of Nakshita Mehta from Credent Asset Management. Please go ahead.
Hi. So thank you for the opportunity, and congratulations on a good set of numbers.
Thank you, Nakshita.
So my question is, one, in the expansion project that we are doing it, I understand, for nitrile latex, right? So how much revenue are we expecting out of it, incremental revenue? How much incremental EBITDA margin are we targeting?
Look, we are doing 2 projects. One is mostly nitrile latex in our Gujarat facility, and in Taloja is a multi-purpose latex plant. In the beginning, initially we are looking at a total of additional 60,000 tons, which would give us about 500 crores of revenue. But as I've mentioned before, that the additional capex that will be required for an additional revenue that will come, another 300-400 crores, will be at a marginal cost. So
Okay.
So it will be for about 500 crores of revenue once both the plants are fully utilized.
Right.
And as far as EBITDA margins is concerned, obviously, look, EBITDA margins should only improve because the fixed costs will not increase by that much. So we are hoping as we grow the capacity utilization, as we increase the capacity utilization of the new plants, EBITDA margins should only go up.
Okay, but is there any particular number we are targeting for EBITDA margin?
No, as I told you earlier, that in percentage margin varies quite dramatically in our kind of business.
Okay.
We would be satisfied with anywhere between 13 to 18% is what 12 to 18% even is fine, depending on where oil prices are. The most important metric for us is return on capital, and as long as we're delivering a healthy return on capital, EBITDA margins, we're happy to let it vary.
Correct. Okay. And this nitrile latex we're mainly using for Apcotex, is it?
No, nitrile latex is not at all for Apcotex. That is for the glove industry, medical glove industry.
Okay, glove. All right. Also, my another question is, what would be our EBITDA per ton? Can you give us a specific number right now, presently?
No, I'm sorry, we don't reveal those numbers. Again, as I mentioned, we would love to be as transparent as possible, but I'll say the same thing I said to the previous caller, that it's, for proprietary reasons, there are certain numbers about volumes, EBITDA per ton, those kinds of things. We've taken a conscious call, and we've done it consistently for years, by the way, that we just don't give those numbers out.
All right. Okay. And now my next question is on your revenue stream. So which sector would you think, can you just give us a breakup from where is the major revenue? Can you throw light on that?
So what do you mean by stream? If you can elaborate on that question.
Basically, the sector. So goes into paints, also construction chemicals, and the synthetic rubber, the paper companies, carpet, gloves, construction, automobile, footwear. So where, can you just give us a rough breakup as to where is your maximum revenue?
We are actually quite well diversified, I would say. We have a few industries that we are catering to. Obviously, like one of the large industries would be paper and paperboard, but even that would not be more than 20% of our overall sales. Maybe less than 20%, in fact, now in the current context, 17-18%. Then followed by construction, which includes construction chemicals and paints. Then followed by tire industry, carpet.
Right.
Sorry, there's also NBR, which goes into several industries, right? Which is a lot of rubber industries. So that would be another 25% of our sales. So
correct.
Fairly well diversified.
Okay.
We're not dependent on any one major industry. Nothing is more than 20% of our overall sales.
Okay, so it's basically well diversified. So there's no concentration in this sector.
No concentration.
Okay, perfect, great. Thank you so much. That was it from my side.
Thank you.
And, good luck for your coming.
Thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Farokh Pandole from Avista Fund Management. Please go ahead.
Yeah, hi. Congratulations on the solid numbers. I just had a couple of questions on the capex, and I think firstly, hello.
Yeah, go ahead. Hi, Farokh.
Yeah, hi. So firstly, on the NBR, as you rightly said in response to an earlier question, that both from a macro and a business standpoint, I think things are going pretty positively for the company at this point in time. And so why would we not, and our balance sheet is very strong, and obviously cash flows, etc., are favorable. So why would we not accelerate that process in tandem with the existing plan that we have for this year, rather than waiting for 23, 24, and thereafter the gestation period of putting up the facility, etc.? Why would we not work on that in tandem and be a little bit more aggressive over here? So that was the first part. And the second is, if you could just mention the capex again, what you had said, the capex which has already been announced for the, I think you mentioned 500 crore incremental revenue from that capex, and then you also mentioned the further 300 to 400 crores. So is that on a second leg of minimal investment that we could get that incremental? Did I understand that correct?
Yes, that's correct. So I'll answer your second question first. Yes, that's correct. So just to clarify that these two projects that we are doing is about 180 to 190 crores of capex. Both the projects are on schedule and likely to be, at least for the trials to start sometime towards the end of Q2 and early Q3. The total, so for the 180 crores of capex, we are looking at about 500 crores of revenue. In addition, after that, there'll be perhaps an incremental capex of, it would be under 100 crore. It will be in two digits, somewhere and within two digits. We haven't worked out the exact number, but intuitively we know it will be quite good. And we expect another 300 to 400 crores from that, from the incremental. Because, a lot of the civil, the buildings and so on, they have been created in this first phase. So Afterwards, we just need to add the equipment as and when required. So that incremental capex could even happen, one by one. It may not even happen at a time. So that's something we'll look at depending on the demand and how things are going.
Sure. And obviously, time won't be a factor to that as well. As you say, you can do it.
Not as much. It won't be. Max. Sometimes some of these things have a lead time. Some of the equipment have a lead time of 6 to 8 months. But that would be about it. Nothing long like civil. There's no civil jobs and stuff that will be required then. To answer your first question, you are absolutely right, and we have debated it over, whether to be aggressive with NBR or not. Frankly, we went through a period of about a year and a half when NBR margins are very low. As you know, we filed for anti-dumping as well, which the DGTR in fact sided with us, but unfortunately the Ministry of Finance did not notify for various reasons. That's in appeal. We have gone in appeal and that's in the courts now. We don't know how that will pan out. So I would say the last 1 year has obviously been better. We're also waiting to see, that there are obviously overall on the macro side of NBR globally, one of the biggest consumers of NBR globally is the automotive industry, and it's the traditional automotive industry. So if there was a huge change towards electric vehicles, then there could be an impact of slow demand, while the rest of the market where NBR is supplied is growing quite well. But if automotive were to come down, there could be a glut of NBR in the market, which could result in depressed global margins. So therefore, we are just waiting to see. Also from just a management bandwidth point of view, which of course is something we could do, but and also we need certain environmental permissions which we have already applied for, which should come through this year. So even if we wanted to, we could not start that plant till we receive those environmental permissions, which are expected in this year, in 2022. And so for both 2 or 3 reasons, we have just decided to, go a little bit slow on that and just wait and watch to see what happens this year.
Right. And also you mentioned that you were operating at full capacity and that you had to weigh some orders, both export and domestic, in this quarter. Now, for the fourth quarter and for the first quarter of the next fiscal, until such time as the sort of next leg of capacity comes on stream, which I'm presuming will be the second quarter of the next fiscal year. That's the September quarter.
In fact, by the time the volumes hit, it will be the third quarter. So, yes. Because when we start commissioning and trials, it will be end of Q2 and early Q3. Our Valia plant should be ready first in end of Q2 and Taloja, the expansion plan will only be early Q3. So obviously by the time the volumes and, obviously with being a new plant, they'll also take some time even existing customers will want to take some trials for the new facility before, scaling up. So I just wanted to correct that. So it's in fact the next 3 quarters that we are going to, we are 100% capacity utilization.
Sorry to interrupt. May I request Mr. Farooq to please rejoin the queue? We have participants waiting for the turn.
Or
let me just finish this question. Yeah, go ahead, Farooq. So what's your question?
Quarters, do we have anything to mitigate this issue of capacity, coming up against capacity? Are there any things that we're working on for the next quarters?
Unfortunately, yes, we are. The short answer is yes, we are working on certain things, but also we don't expect any major uptick. We in fact created almost 15% extra capacity over the last couple of quarters, and at least as of the last couple of months, even that has been completely used up very quickly. So the demand has been extremely strong. We do expect that in the second Q2, some of our segments, some of the industries, like construction and paper, even to some extent, because of the monsoons, so demand does come up. So in that case, we will take more export orders. But you're right, in terms of financial numbers, in terms of volumes, I would say there isn't much room for significant growth over the next 3 quarters.
Got it. Thanks. Thank you very much.
Of course, compared to Q1 of last year and compared to Q2, we would grow because of, we didn't have those capacities then.
That's right.
But compared to, I would say, Q4 would be somewhere at the max levels if Q4 goes well. And then Q1 and Q2 would be, I would say, similar to Q4. Maybe a little. We're trying to do small things and tweaks to, get as much out of the plant as possible.
Understood. Great. Thanks a lot and all the best.
Thank you very much, sir.
Thank you. The next question is from the line of Nikhil from Perpetual Investment Advisors. Please go ahead.
Yeah. Hi, Abhiraj and team. Congrats on a great quarter again.
Thank you.
My first question is about this quarter. So Q1, while the sales is more or less the same, our gross profit has gone from almost 70 crores to 88 crores. At least as per my estimate, the EBITDA should have been higher. So what caused this significant growth in other expenses? Could you help us understand that?
Look, there are a few things that have come about. One is, and I'll have to go and look at the numbers, but obviously, because of COVID last year, there were no increments. Obviously, the employee costs have gone up because we've had to give reasonable increments this year. If you look at Q3 of this year against Q3 of last year, so obviously the overall employee costs have added to the team size. Team size has gone up, so overall employee cost has gone up. In addition to that, because there have been a few good quarters, we've also taken up. And frankly, last year, because of COVID, for 2 reasons. One is because of COVID, we couldn't get a lot of contractors into our plant, so we didn't want to get a lot of contractors. I'm talking about 2021. And so a lot of repair jobs, and maintenance jobs were held up, which we have really taken up in Q2, Q3, and we're going forward also for the next 1 or 2 quarters before the monsoons. Those are the only 2 reasons that I can think of. Other than that, as I said, we look at EBITDA per ton versus EBITDA margin, and we're quite happy. And EBITDA per ton has actually gone up for us. I know we don't give those numbers out, but EBITDA per ton is up by 15-20%. So we're quite happy with that.
No, because there's no one-time expense in this other expenses in this quarter, is what I actually meant to ask here. Apart from
there is no. These are regular expenses. These are not one-time, but these are regular expenses. As I said, sometimes I was just giving an example of certain repair works, painting works, that are significant, but we couldn't do in the previous year, which we have taken up after the monsoons of this year. So that may have been to some extent, but.
Okay, because then in that case, broadly, I think that NBR is probably doing pretty much well for you now. And since butadiene was down almost 50% in last quarter, so there should have been a margin expansion which has already happened. So why?
No, but just because a raw material goes down does not automatically mean margin expansion happens, because we are also forced to pass along that
Of course,
cost
you must
increase
have
or
taken a price
so,
decline in your end product.
so in
also.
fact, Q3 compared to Q2, our value growth has only been 3%, but our volume growth has been, more than double that. So we've actually had to, give some decline to our customers as well. Some of it is on formula pricing. We do some of it are annual contracts on formula pricing.
Okay. So if we continue Q4 at the same rate, would other expenses be the same in Q4 and Q1 and so on?
I think so. Oh, yeah, one thing I must mention. Sorry, there's one more reason for other expenses. I'm glad you mentioned, you brought it up. For one of our plants, we run on thermal power plants. So, and also the boilers, backup boilers run on gas. Both gas and coal costs have gone up significantly. So that also plays a part in other expenses.
Okay, so are they normalizing now or no?
I would say they've reduced in the last month or two, but not what they were about a year ago, for sure. So that's something we've had to absorb.
Got it. So would that be double of what you usually do?
It was specifically the coal costs were more than double of, let's say, a year ago.
Okay. And so after debottlenecking, can you tell us what is the capacity for latex now? I think it was 55,000 tons before debottlenecking, and can we assume it to be 63,000?
Yeah, it's about 60, 62. Yeah, we are on the run rate of about 60 plus. Yeah.
Okay, and you already mentioned about CE staff, so nothing on that.
Yeah, and 60 plus. I just want to mention when we mention capacity, obviously, look, we have many products. And depending on the cycle times, if you were to only manufacture products with lower cycle times, we could even go up to 70, 70. But sometimes we take a conscious thought. We want to be, across the board in several segments and several industries and several customers. So currently at 60, 62. Yeah.
Understood. And one last question is, what was the split between rubber and latex in the last quarter?
I don't have the exact. Sachin, I'll just request one of my colleagues to answer that. Sachin, Suraj, do you have that number? It's in one of the Excel sheets. If you can look it up. I think it's about 55-56% latex and 45% rubber. It's been about the same for the last few quarters.
Okay, no problem. So all the best going forward.
Thank you very much.
Thank you. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question, and congratulations, sir, for a good set of numbers. So most of my questions are already asked. So just a few things. I mean, when we are talking that volume growth has been close to around 20% this quarter, where we have seen maximum traction, or it is across the segment? And secondly, if we say 20% volume growth was there, so and obviously we are almost full of capacity. So next quarter, since prices have been, what I feel is that the price increase which has happened in the commodity prices and the price realization what we have been taken, maybe still something is pending which could reflect maybe in Q4 or Q1. So I'm just assuming that maybe volume growth would not be that significant from the Q3 levels, but still there's the room for realization improvement. So these two questions are from my side.
Yeah, look, the volume growth, as I mentioned, that most of the debottlenecking projects were completed in Q2 and Q3. So Q4, of course, we would have a little bit more headroom for volume growth, not significantly more, but a little bit more. And as I mentioned to one of the previous callers, that Q4 onwards, maybe for another 2 quarters, we may not have headroom for volume growth. But exactly what you said is right, that we obviously, depending on customer mix, product mix, some amount of headroom for margin growth as well, because we are running at 100% capacity utilization, because the demand cycle is quite strong. Obviously, we will try and do that, and we hope to do that. So in terms of profitability and bottom line, we hope to improve on Q3 numbers going forward.
Okay. And in about that growth, this volume growth, where we have seen maximum traction, or is it
It's frankly across the board. We have seen domestic, international, whether it's paperboard, construction, textiles, carpet. It's really, almost across the board. And of course, medical gloves right now, obviously the demand is high, and whatever we can manufacture from our current plant, we're supplying. The one place where we don't see great amount of volume growth is the automotive industry, where we are supplying NBR to. But the rest of the industries where we are supplying NBR to, industrial components, hoses, all kinds of other agriculture products, there we are seeing good growth, except automotive, which obviously, mainly because of the chip shortage, I would say most automotive companies have not been able to. So that's been the only one point of where there is not been much growth. But again, we are running at 100% capacity utilization. So if there was growth, we're not able to give any more NBR.
Okay. Fair. And just one last question on the balance sheet side. I mean, looking at the capex which we are looking at, how our balance sheet will be looking like? The cash positioning and the debt position would be?
Yeah, look, as on March 31st of last year, we hardly had any loans. I don't think, maybe a little bit working capital loan and one small term loan was there. Obviously, we will be taking, or we have already taken some debt for CapEx. So the entire CapEx will be funded from these 2 years cash flow, which is FY22 and FY23, along with some amount of debt that would be needed for the CapEx, which we hope to repay it back shortly thereafter.
Okay. So I mean, overall, what sort of debt number would be there for FY23 maybe?
Maybe close to around crores.
Okay. I mean, not more than 150 crore, kind of 100, 150.
Yeah, 100 crores term loan is what we expect to utilize.
Okay. That's it from my side. Thank you.
Thank you very much.
Thank you. The next question is from the line of Manav Vijay from Deep Financial. Please go ahead.
Yes, thank you for the opportunity, Biraj. So first of all, so my first question is actually a slightly broad question. So we have been hearing that some of the logistics issues. First of all, since you import and export a lot, if you can help us to explain as far as the logistics costs are concerned, the container availability, the debottlenecks that were there with, I would say, with China. So all those issues are still persisting, or there is some respite on those issues, because many companies have been mentioning that it is not the demand which is fueling the inflation. It is these debottlenecks with the supply side, due to which inflation is higher than normal.
Yeah, that could be the case in terms of inflation. I don't know. I mean, there are multiple reasons for inflation. That's not the only reason. I would not say that's the only reason. But as far as the company is concerned, we have, I would say the issue of supply chain was peaked in Q2 in terms of, a lot of problems that we had to get raw materials. We were fortunate that we didn't have any major issues, but we did have some delays. We did have some shortages, but we were able to overcome them. One of the things we have done is, of course, increased inventories. Obviously, not the most financially prudent thing to do, increasing inventories, but in the current context of where the world is with so many uncertainties, with a lot of dependence from China, direct or indirect. Even if you're not directly importing from China certain critical raw materials, our vendors' raw materials can come from China. So because of that, we have taken a strategic call to increase all our inventories of some critical imported raw materials, especially. But we have seen in general, while there have been delays, obviously shipping rates have gone up substantially. It's not led to major issues in terms of our supply chain and our production.
Okay. Okay, this is helpful. My second question is, as far as your XNB latex is concerned, so apart from Top Gloves, have you signed up with other manufacturers as well?
Yes, of course. We have many customers. There was just one or two that we have mentioned in our presentation because they're the well-known customers. The other problem that we have is a lot of other customers are telling us that, look, you don't have the capacity now. Why would we go through this whole process and, you won't be able to give us anything for another 9 months. So why don't you come to us closer to the date and then we will go through the process. But in a lot of them, we have done lab trials and whatever we could. But unfortunately, we're not able to give bulk quantities because we just don't have the capacity today.
Okay.
And it would be at the expense of our current customers, which also we don't want to do, which is not a good idea. So.
Correct. Agree. So in that case, Abhiraj, since we will have the capacity available, let's say by Q3, and we will be done with all the trials as well. So would it be a safe assumption to believe that in FY24, you can run the plant at full capacity and you can generate 500 crores of top line from that from both the plants put together?
Well, I mentioned in one of the previous calls that, the safe assumption would be at least 6 months to scale up. So I would say if not 500 crores, we should be able to do at least, 70, 75, 80% of that in FY24, assuming that we take, 6 months from November to scale up. So it may take April, May to scale up. And it could be even a little bit longer than that. So, the quality issue, it's not only about the quality and the volumes, but it's also about supply chain and getting that right. We would have never done these kinds of volumes and supply chain, and while we're working through it and preparing for it, when it actually comes to executing it, we experience that there are issues. There can be unforeseen issues that do come up. So I would say 6 to 12 months is what I'd mentioned in one of our previous calls. We will hope with 6 months. It could be as high as 12 months to completely scale up.
Sure.
So I don't think the entire 500 crores in FY24, but we do hope a large majority of that would happen in FY24.
Sure. Okay. Now, Abhiraj, since your Top Gloves is actually listed and they also declare results every quarterly, so they have detailed out even their expansion plan in terms of doubling the capacity from almost 100 billion pieces to 200 billion pieces over next 4 years. So whatever will be their requirement, let's assume for a second that Top Gloves will be your wholesale buyer. So at let's say 200 billion pieces, how much percentage of their raw material you would be supplying at your max capacity?
Look, I would say I don't have the exact calculation with me, and I don't want to talk about one specific customer, etc. But one thing I can say for sure that even today, even with our total capacity that is coming up, it will not be enough for 2 or 3 of the largest glove manufacturers. Their consumption is already more than what we can supply for each of them, one of them.
Okay, so let me ask you slightly differently. So you will have a 40,000 ton capacity, and if you decide to...
No, it's both put together 60,000 tons.
Okay, 60,000. So 60,000 including the second order of expansion as well, am I right?
No, this is in our first phase between Valia and Taloja. We'll have about 50,000 in Valia and 10,000 in Taloja. Whether or not we use the Taloja capacity to supply to the glove industry or our current, some other product, that is a decision we will take later on. But at least as of now, 50,000 has been earmarked for the glove industry.
Fair enough. So on 50, you will add. So on 50,000 tons, you will add around 50% as well. So at around 75 or even at 85,000 tons. How much of the total industry capacity you will have? 5%, 7%, 10%?
No, not even 5%. Because
not even 5%.
Not even 5%. I'm talking about global
Correct.
capacities. Some of the large players in this industry are much larger. than us, and they are also adding capacity. As you know, the glove industry is growing, nitrile latex industry is growing. So, I mean, I don't even think 5%.
Sure. Okay. Now, Abhiraj, in last almost, I would say 18 months, your top gloves, which used to do around 15, 16, 17% of margins, went up to 63%. It has again come down. Now, because of this wild movement of margins, the pricing that you get from them, or I would say even from other players, is that pricing is also under pressure, or no?
Look, when we initially made a decision to get into the nitrile latex market, there was no COVID. This was back in 2016, 17 when we started developing it. Obviously, during 2020 and the first half of 21, glove availability and glove demand and glove availability, and therefore glove prices, whether it's natural gloves or nitrile gloves, were at historic highs. And therefore, obviously, the players that were in the nitrile latex market also got good margins. Now, the margins, I would say, have normalized. They are not under pressure, but they have normalized than what they were earlier.
Correct.
Than what they were for the year and a half. And so all our projections have been based on normal margins. Our returns have been based on normal margins. They are obviously not as great as they were 6 months or a year ago because, demand has come off now for gloves in general. There was also a lot of inventory and so on. But that's fine. And that, every industry, whether it's carpet, tires, paper, they all go through their ups and downs and demand cycles.
Correct. And Abhiraj, in this X&B latex, what kind of working capital requirement will be there? Because in your existing business, you have around so you are generally between 30 to 45 days kind of a number. So this would be the similar number even for the expansion, or would be slightly higher?
Sorry, it was a little breaking in between. I am not sure if I caught. Yeah.
I'm saying in terms of working capital for this project. So as of now, the working capital that you have ranges between 30 to 45 days.
Yeah.
So even for this expansion, you will have that kind of working capital cycle, or it will be slightly different?
No, it will be similar. It will be quite similar.
Okay. And last question from me on your investment portfolio: have you booked any profits or not?
Yes, from time to time we do book profits. As I've mentioned before, that all this is managed by outside financial wealth advisors, and they do book profits from time to time, as and when they feel it's right. And of course, they keep us. We have almost a monthly call with them, and we take calls. Yes.
Sure. Okay. Thank you, and all the best.
Thank you very much.
Thank you. Participants are requested to please limit their questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Alisha Mahawla from Envision Capital. Please go ahead.
Hi, sir. Good afternoon, and thank you for taking my question. So my first question is it possible for you to call out what has been the volume growth Q on Q?
It's been about 20%.
It has been 20%.
Yes, volume growth quarter Q3 of this year compared to Q3 of last year.
No,
Is that what you meant?
No. Q2 versus Q3.
Okay, it's about 6%.
6%.
Yeah.
Okay. And can you also mention what will be the peak revenue with once the additional capacity comes on stream, excluding all the pricing, the high realizations that we're currently witnessing? Like you mentioned, 9 months are almost 30-40%. So if we exclude all that with the capacity and new capacity that comes in H1 of 23, what will be the peak revenue?
Frankly, I don't know what is high and low. We have had higher back in 2011. Somebody could argue 2021 was the lowest, and it's never going to come back again because of COVID. So I would say there is no high or low. It's what it is, and we've been wrong before on what's high and low. But assuming at these levels, which is, let's say we are already at a run rate of 250 crores from our current facilities, our current plants, which means we are already at a run rate of about 1,000 crores, which will add another 500 crores at the minimum. And then, as I mentioned, that we will have, created enough capacity to go up by another 300-400 crores. So, for which there will be additional investments. So we think at the peak we can do 1,500-1,600 crores, as much as 2,000 crores, once we do the second phase of expansion.
Okay, sure. And just one last question. In NBR, what is the split between auto and non-auto?
Typically in India, auto is about 25%, 25 to 30%, maybe 25, not 20%, maybe a little high. 25-27% of the total NBR consumption in India is auto. Globally, I think that's higher. The number is higher. Globally, the number may be about 40%, maybe auto.
Okay, thank you.
But we are largely in the India market so far.
Okay,
for
so
NBR.
it's up 30% of the NBR revenue.
Yeah.
Okay, thank you.
Thank you. The next question is from the line of Keval Ashar from DSP Mutual Fund. Please go ahead.
Thank you for taking up follow-up question of mine. So, sir, since we are expanding into export markets, wanted to know where there is presence of much larger players, what is the edge that we have over them?
There are multiple things, there are 2-3 things, but one of the things is obviously that the technology with which we are manufacturing has been different from what they're doing. We believe there are certain inherent advantages that we do have. Second is, as I mentioned, that export markets, if you were to export to, let's say, America or South America, North America, South America, I would say we're at a disadvantage because of the freight costs and so on. At least Southeast Asia and Middle East, we feel that, we are fairly competitive with our raw material costs. Most of our large some of our raw materials are available very close to our plants. The others are imported, but again, available close at very reasonable rates from the Middle East, Saudi, Kuwait, etc. The technical service, the customization that we provide versus some of the large players, in the past has really been our competitive strength and advantage and helped us gain market share. And we think we'll continue that path. Having said that, we have to, not to say that, we can do away with our competition. They also have certain advantages. They have scale. They have the depth that, we have to build over time. And but certainly we feel confident that we can at least compete with them in the market, both from a cost perspective, quality perspective, and service perspective.
Okay, so got it. And one more question is on the raw material side. So we import majority of our raw materials. So do you see any Indian companies in coming times doing capex in styrene and butadiene? And if you have any insight on that.
As far as butadiene is concerned, there is already an excess of butadiene in the country. There have been a few projects announced, but I don't know how far they are in terms of execution. Styrene also, there have been a couple of projects announced, but I'm not quite sure on the execution. However, as far as styrene is concerned, it's easily available from from various sources in East Asia as well as the Middle East. So we feel quite, being in Mumbai, which is close, or Gujarat, both in Taloja and both in Maharashtra and Gujarat. Sometimes the freight costs are cheaper coming in from Saudi or Kuwait or UAE compared to bringing it from Delhi or the east, from the north or the east of India. So we are okay with it.
Okay, got it. Thanks, sir. Thanks.
Thank you. The next question is from the line of Karan Bhatelia from Asian Market Securities. Please go ahead.
Thank you for the opportunity. Sir, 2 questions from my end. One with respect to capex spends for the current year and for next 2 years. And while you mentioned with respect to the asset turns on the ex-NBR business, can you guide us with respect to the asset turn on the NBR business and the normal latex business?
Sorry, just let me repeat the questions. Your first question is on. I didn't hear. What was the first question again?
Capex for the current year and for next 2 years.
Yeah. So current year, I would say between FY22 and FY23, we're looking at about 225 crores. The large chunk of it would be these 2 expansion projects. We're also implementing a zero liquid discharge facility in our Valia factory, which for several reasons. One is obviously environmental, main reason being the environmental reason. So totally about between 200 to 250 crores over this financial year and next financial year. Beyond that is something we are not sure of yet. We will make that decision over the next 6 months. And
right, so
your second question was on
in.
Sorry?
Hello. Yeah, so we aren't still factoring in, NBR capex at least by next year.
NBR capex we're not factoring in this 200 to 225 crores, as I said. Then in the following year, 23-24, we may probably look at NBR capex. We will see, depending on how this year goes. And as far as asset turn is concerned, as I mentioned, we're looking at 180 crores right now for these two projects, which will give us a turnover of 500 crores. So that works out to be an asset turn of, I don't know, less than 3, I guess. But as I said, we are, or about 3, I think it will be. But
right.
Over time, the future capex after that will be at an asset turn of maybe 7, 8, I'm not sure. So average maybe 4, 5.
So my question was, while you shared the ex-NBR asset turn, can we expect the NBR business to be of a superior asset turn to this, or maybe at a lower asset turn to this?
Lower. NBR business will be at a lower asset turn.
Right.
The investment will be as much and the value of revenue will be lower. So therefore, we'll see. Therefore, the hesitancy on whether to do this project, whether to utilize the funds for doing something else, it's not as compelling a case so far. But we may still go ahead and do it because it may be a good opportunity in any way. So we'll see how the next following year goes and then take a call.
So it all depends on the anti-dumping duties, or
no, not dependent at all. No, you cannot put up a project based on government interventions. No, not at all. We would take a long-term call based on what we feel is going on with the market growth, how EVs are factored in, how the auto industry worldwide is affecting the NBR business worldwide. We've had one competitor already announce that they are going to leave this business. If that happens, that may significantly improve competitiveness in the market for the players who are already there. They've announced it, but they have not yet executed it. They've announced their intention to exit the business.
Right.
So we'll see.
Right. So on the NBR business, are we back to the historic, realization and historic margins, or we are far from there?
I don't want to comment specifically because this matter is sub judice. It's in the courts. We have appealed, so I'd rather not just discuss NBR specifically, margins and so on.
Okay. Thank you. Thank you for the detailed answer. That's it from me.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you all for joining us on this Q3 conference call with Apcotex Industries Limited. We appreciate your time, and we hope that you stay safe in these difficult times, and you and your families, are safe. We look forward to seeing you in the Q4 conference call in next quarter. Thank you very much.
Thank you. On behalf of Apcotex Industries Limited, that concludes this conference. Thank you for joining us. Now you may disconnect your lines.
Okay. Thank you.